صل على محمد وآل محمد اللهم صل على We'd like to welcome Brother Aliredha Walji actually for coming here and agree to present Introduction to Halal Investing. As you know, Brother Walji is actually Minnesotan. He's just taking refugees in Orlando. And as soon things come down here with the Trump, he'll come back again here. Anyhow, without taking more of your time, we're going to let him continue with this. And then we'll do question and answer at the end. Yeah? Or we in between you want to do question and answer?
If there is anything while I'm presenting, they can
answer. Okay. It's a free one. Okay, inshallah.
Assalamu alaikum wa rahmatullahi wa barakatuh. Assalamu wa rahmatullahi wa barakatuh. Thank you for the invitation and for the communities. I know we were trying to coordinate between the other center and this center. So it feels that it's a community effort, and even the PowerPoint to get it set up, I really appreciate you guys. I know it's Thanksgiving weekend. You could be eating turkey, relaxing, but you chose to spend your time here. So inshallah, we'll try to make this informative for you all, and give you a chance to ask any questions. If you find something that you want me to clarify as I'm presenting, let me know. Otherwise, we'll have some Q&A at the end as well. So just for a quick introduction, my name is Aliredha Walji. I have been originally from Minnesota here, but living in Orlando, Florida. And I work at a company called Sharia Portfolio. Today's subject is just a quick introduction on halal investing. Some of the topics might seem very basic. Some of it is more, if you're new to investing, you'll pick up something. If you're a seasoned investor, hopefully you'll also pick up something. That's my goal. So we'll go ahead and get started. And a little bit of background about myself. I was, formerly working in the medical path, heading towards med school once upon a time. That was my idea of what I wanted to do. Then I ended up, pursuing a major in biology first, and then did master's in business. And that's kind of opened the door for my journey in the business world. And, working at Wells Fargo initially in the mortgage side. Then I was curious about my 401k, like everybody, right? Am I saving enough? What is my 401k invested in? And I was fortunate to be able to meet Naushad, who is the founder of Sharia Portfolio. He was visiting. And so I picked his brain and I said, tell me about my retirement. What is going on? Am I in the right track? And, the normal questions that people are thinking. And he was able to pinpoint a lot of the things that were not necessarily aligned with our values. And so that opened my eyes. And I kept in touch, and, slowly but surely, when the opportunity came to join, I was able to start my journey. And today, I'm the CEO of the U.S. operations. So we have several entities that are handling different aspects, and I manage the wealth management business in the U.S. So that's my brief background. This is, of course, not specific advice for any person. It's more high-level information. And of course, I want to make sure that the ladies, if they have not received any brochures, they are welcome to, will pass along as well. And there is also information request forms, by the way, that we put some information on the table so that if anyone wishes to learn more about, a particular subject, or be on the newsletter, or have a one-on-one consultation, we're happy to fill it out and we can follow up. So inshallah, I just wanted to quickly point that out. And there is more in the bag in case. So inshallah, we'll go ahead and get started. The best, definition, or the most basic thing when it comes to investing is, what is investing? So according to Benjamin Graham, in his book Security Analysis, who is actually famous for investing, Warren Buffett attributes a lot of what he learned to Benjamin Graham, and he says, an investment is an operation which, upon thorough analysis, promises safety of principal and an adequate or satisfactory return. Anything that does not meet this requirement is considered speculation. So there are three basic things. You need to have a safety of principle. You need to understand what is the margin of safety with any investment choice that you're making. You also want to understand that you're trying to aim for a satisfactory return. You have to have some research and at the same time aim for something realistic. Investing is not gambling, because if you're not doing that, you're essentially speculating, which is equivalent to gambling. So this is the technical definition of what investing is. And we'll cover more as we go as to what we do and what are some of the different ways that you can invest. And then, open it up for Q&A as well. So what is we do? What is Sharia Portfolio? Sharia Portfolio, began in 2003 with the idea that we wanted to offer professionally managed investment solutions for Muslims to help them achieve their financial goals without compromising their personal values. So most of us, when it comes to eating food at the masjid or at our homes, we're customized to, we're accustomed to the idea of eating halal food, right? You're not going to question the chicken or the meat, whatever you're eating. But most of the time, we don't realize that our investments end up supporting or going against, I should say, our values. And that's why we felt a need to offer investment solutions so that people do not feel like they have to go against their values, and there is a way to actually go about doing that. Even if you choose to do it yourself, we'll go over some of the ways that you can do it. But the 4 cornerstones that I like to highlight is a holistic wealth management that is taken into consideration. It's not just a quick opening of an account. It's about understanding each person's unique goals and preferences, and then coming up with a portfolio that is designed for them. It also requires working with a fiduciary. As a fiduciary, how many of you have heard the word fiduciary? Right? A fiduciary means you're working with someone who is looking out for your best interest. So a lot of times people are looking out for their own interest. That means they're not always giving you the best recommendation. Fiduciary, based on how they get paid and based on how they're required by law to protect your interests, this is what the role is, and we have to abide by that. Sharia compliance is the other element that I just highlighted, and we'll talk a little bit about what that is in future slides. And there's a lot of research, as we mentioned, to be able to conform to that in investment definition. So in 2003, it was under the Walji Investments umbrella. Naushad Walji, the founder, so he put Walji Investments, and Sharia Portfolio was under that. In 2014, which is when I joined, they were looking to expand into multiple territories. And so it was registered as a standalone company under the SEC umbrella. And so that is when that big journey in marketing began, to be able to offer to more and more territory. In 2019, SP funds were launched. How many of you have heard of SP funds? None. Okay. So most of the time, a lot of people may have already heard about SP funds. So SP funds are a family of ETFs, and now including even target date funds. And there's also private funds that have been launched under the umbrella of SP funds. So a lot of times Muslim investors, or any investor in general, is told, you want to invest, you don't know what to buy an index fund, right? You've heard of this. And so for the Muslim investor, if you buy the S&P 500 index, you're going to buy the top 500 companies through that fund. But not all of those companies are going to be aligned with our values. And some of those may be contradicting with the values. So we worked directly with S&P and Dow Jones indices to, number one, establish the index, and number two, provide the products that are conforming to our values. So for example, one of the product is called SPUS. It's a S&P 500 Sharia Industry Exclusion Fund that excludes the non-halal stocks from the S&P. And you end up with SPUS. And this is an example of one of the funds that SP Funds Management has been involved in. And today, SP Funds, in conjunction with SPUSA and all the funds that we're managing and all the assets, we are currently close to $3 billion in assets. And a lot of that success came from the SP Funds, not just from the Muslim investors. A lot of this is from the mainstream, JP Morgan, Franklin Templeton, and others. They're buying almost every week. We're seeing huge volumes for this. In 2020, we wanted to launch our services internationally, so we set up offices in Canada. And through that, we're able to work with clients in over 14 countries as of right now. So SP has basically grown. Sharia Portfolio has grown. In 2024, we hit our first milestone. We crossed $1 billion in assets under management. Assalamu alaikum, Inayat. How are you? And in 2025, March, we crossed our 2nd billion, and we're almost at the 3rd billion right now. So alhamdulillah, through the support from the organizations, as well as from the institutions, we have been able to achieve these milestones, and inshallah, more and more to come. And one of the things that was mentioned is we have SP Finance. So this is another one that's just launched this year. It's another affiliate that is looking to offer ethical, financing, where there is no interest involved. So there's credit cards and auto loans and other things coming in the pipeline that are designed to have zero interest. So this is something exciting that is in the pipeline. So I mentioned some of them. There's private funds under the SP Funds umbrella, which includes real estate funds, digital asset funds, and also other private equity offerings. In the fixed income category, there's something called Sukuk, which is the alternative to the traditional bonds. Bonds traditionally pay interest, Sukuks pay a dividend, and they help to still function in the fixed income category. So our team has been involved also. One of the funds was to launch a Sukuk fund that didn't exist before. And alhamdulillah, we've been able to be involved in that. And these are all the other things that are highlighted here. So why is investing important? Anyone want to tell me one reason why investing is important? Muhammad, assalamu alaikum. I'm going to pick on you, Muhammad. One reason why investing is important. Economic security, fantastic. Anyone want to share on this side? Why is investing important? There you go. It grows your money instead of leaving it in the bank, because money in the bank is a melting ice cube. Hansele? Yes. Yes. You can ask right now if it's going to help in a particular slide, otherwise at the end.
Since we are live streaming,
Sure.
she wants to hear the question.
Okay, yes, for the benefit of the online audience.
In terms of compliance with Sharia, so my question is that we have different scholars, I mean Shia and Sunni. So is there any conflict between these two?
I'll answer that in Sharia slides.
Oh, okay, so perfect.
There's a Sharia compliance section. I'll cover that inshallah.
Okay, thank you.
But I want one reason for why investing is important from you.
Because we have inflation.
There you go, fantastic.
And,
that's the one I like the most, which is what I'm highlighting here. If you look at the power of the US dollar in the last 30 years, if you leave it in the bank under your mattress, it lost over 55% in value just by doing nothing. On the flip side, you put it in the S&P 500 or equivalent fund, you would have grown over 920% or 970%, almost 10% a year. So this is the reason, one of the main reasons why we invest, because our dollars keep depreciating in value every year. 8 years ago, typical home cost how much? Median-sized home, $280,000. Today, a median-sized home is $450,000. Well, people's income didn't go up that much, right? Average household income right now is $80,000. The affordability required, the income required to afford a typical home is $125,000. So not everybody makes that kind of money in the US, and so there is a big gap. And this is why we have to invest to keep up with the cost of living. Here are some other reasons. Nobody's interested in retirement, but this is one of the key reasons why investing is important. Hopefully one day we want to work because we want to, but not because we have to. And retirement is one of the reasons that is very important. Fidelity Research has actually mentioned that for those who are starting out, most of you are in the middle to upper levels of your career, hopefully. But those who are starting out, generally they recommend putting about 15%, 20% of their income towards retirement. And a good rule of thumb, again, this is not for everyone, but a rule of thumb is you need about 10 times your pre-retirement income by the time you hit 67. So for those of you who are planning, this is what the Fidelity Research is suggesting based on cost of living adjustments. And thank you, Sayyid Kadhim, for the amazing car, mashallah. Inshallah, this is one of the reasons why, or actually Muhammad Sabur, he's the car lover here. Sayyid Kazim, that's his house right there. Just one. and Hajj. But these are some of the other reasons why investing is important. So retirement, as I mentioned earlier, you need about 10 times your annual salary by 67. This is one key thing to keep in mind. And the sad part is that if you look at the different cohorts, right, people who are 65 to 74, you would think that, they need to have close to $1 million, but on average, they have about 200K. That's it. So they're very much behind in saving, which puts them at a disadvantage, and they will be reliant on Medicare, Social Security, safety nets, which may or may not exist, right? I mean, the whole that unfunded liabilities is called. It's over $200 trillion, which is what Social Security, Medicare fall under. And so my generation, I don't even think we're going to see that. But different just slides, charts to keep in mind. Education is one of the other considerations. I apologize if it's a bit fuzzy here, but sticker price on an average four-year, actually, it used to be about 100,000, but it's actually close to 170,000 average four-year institution. And mashallah, how many of you here have graduate degrees, right? So you're the ones who decided to take on more debt, or somebody else had to pay for your tuition. So if you have children, I've been blessed with 5, so I have to constantly think about this, and I have to keep putting money away for them every month so that they're ready for college. Even if they decide not to go, you want to set your kids up for future success. Maybe they want to be an entrepreneur. You can give them some seed funding to get their journey started. So this is a key point to keep in mind, is education expense is becoming just as high as a mortgage expense. One thing I've mentioned, and I find this to be useful, so I put it up here, is donor advised funds. How many of you have heard about this? All right, just one person, so a couple of people. So I think this is an untapped area that can help individuals save on taxes on the one hand, because you can donate appreciated stock. So let's say you have a brokerage account and you did amazing in your holdings. There's a lot of gains. Now what happens when you have to trim or you have to sell at some point, right? You're not going to hold something forever unless you're buying winners all the time. At some point you have to lock in the gains, right? So when you get ready to sell, what happens? You have capital gains tax, right? IRS has to get a piece of that action. But if you were to donate some of that stock into a donation account, the donor advised fund as an example, you're now able to reduce your tax liability because you don't pay the capital gains tax, and you get a tax deduction on the amount that you donate. So it's a dual benefit. And then on top of that, the funds that you have deposited into the donation account can be invested. They can grow. And the growth is tax-free because it's not your money anymore, it's donation money. And then you can donate at any time in the future to any 501c3 nonprofit organization of your choice. So there's multiple benefits for this. For masajid and nonprofit organizations, they can tap a lot of folks who have money in their donation accounts. They can donate stock to the endowments or masjid operations in some way, shape, or form, can benefit from this. So this is an area that we are able to help facilitate for the donors, for the endowments who are looking to set up for the masjids. We can help those institutions set those up. And I think it's a win-win across the board. You can donate cash, also appreciated securities. So just wanted to quickly mention that. So as you're getting started in your investment journey, right, when you're young, you might have a little bit of investing in your equity portfolio, but your primary revenue, right, either you're self-employed or you have a W-2 employment somewhere, a job that you're working. That is where most of your income is coming from, 90% as an example. And you have a small stock portfolio, and maybe real estate could be the other. But what the idea is, over time, you want to look like what's on the right of this chart, whereby you have built up your stock portfolio, you have built up your other categories, maybe real estate has done well and you have a good portfolio there. And so your primary job now, or your primary income source, does not have to be your day job, right? And if you choose to still work in your 60s or 70s or 80s, it's because you want to. And this is what our idea of helping you achieve financial success should look like over time. Now, it's not going to look the same for everyone, but hopefully you can be at this level if you start and are focused in your financial journey. So we need to focus on the Sharia compliance a little bit, the question that came up earlier. What is halal? So halal investing refers to investments made in securities which conform to the guidelines that are set forth by a trustworthy Sharia advisory board. If it conforms to that, then that's what's considered halal investing. So what is the advisory board that we follow, and actually is also considered the gold standard of investing in the globally? So there's an organization called AOFI, which stands for Accounting and Auditing Organization for Islamic Financial Institutions. It's a Shura Council of Sharia scholars, finance professionals from around the world, and they set the guidelines on what is permissible and what is not. And I'll go into what the guidelines are shortly. On our team, we have someone by the name of Sheikh Umar Khan. He is a Sharia scholar. He's a mufti from the Sunni world, and he has a certification on the 6 canonical books of hadith that they follow. And he has a master's in finance and Islamic finance, so he has all these qualifications as well as AOFI certifications. So we are utilizing him as our Sharia advisor. And I know there was a question on how it differs from our madhab, so I'll cover a little bit of that. But what do we look at exactly? Obviously, we're going to avoid industries like gambling, weapons manufacturing, right? People are complaining about Palestine and all these things, but you have Raytheon in your portfolio, or you have Lockheed Martin. So we have to be mindful of these things. I mean, I'm not here to scare people, but this is the reality. So we want to avoid weapons, adult entertainment, so on and so forth. But there is additional screening that needs to be done. How much debt the company has relative to the market cap? What about the cash that they are holding relative to their market cap? What about the secondary business sources? Maybe the primary business is in a permissible industry, but they might be earning additional revenue from other sources that are not considered permissible. So we have to be able to filter those through certain screening tools to identify whether or not they're failing the Sharia filter. And generally, this is what the whole criteria entails. So when it comes to the question that you asked about our faith, I know there is more flexibility from what I've heard, from what I've seen with our madhab, where, for example, interest income is permitted because you're not requesting it, you're living in a country that is based in the interest, and if you put it in a financial institution and they give it to you, it's fine. So that's one of the differences. The other difference in many cases is you're allowed to invest in something, it's basically ignorance is bliss, is what I've been told many times, right? You don't know what you're invested in, and as long as you don't have certainty about something, then you're fine with it. But I tend to challenge that a little bit because there has been research that has been done to show a better path. So I tend to say, look, if there is a better path that is more restrictive, maybe you are willing to be more liberal with your interpretation, fine. But the restrictive path covers you at the end of the day. And what is your objective with your investing is to achieve a certain targeted return. So if you can achieve that by being in a more restrictive, path, then so be it, right? And if it's better, and there's actually some evidence that it is better for you. Like most of the time we are screening to avoid debt, right? What was the primary cause of the 2008 financial crisis? Too much debt. So by avoiding leveraged companies, we're able to actually be in a much better position to mitigate those kind of shocks that happen in the system by avoiding leverage as one of the examples. So again, I'm not a scholar, I'm not a mufti, but this is what we have found that is objective criteria that we're utilizing. This will work for you, right? Muhammad Ali Muhammad Salawat. Intermission. All right, so now we go into the different investment strategies. This is the fun part. Investing is about investing for the long haul. Don't get greedy, except when there's fear, right? As Buffett says. So there are different styles, right? Think of it as a restaurant, right? I try to use this analogy. Growth strategies are equivalent to those who like spicy food. How many of you like spicy food here? Right. So, when you go to the restaurant, you like the spice, then you should be able to handle the side effects of the spice too, right? You take too much spice, you might have a problem the next day. On the other hand, we have value investors who they like it more bland, less flavor, but they like it because they don't want trouble the next day. They want to sleep well at night. So just some simple analogy. But basically, when you go for growth strategies, you're buying companies with higher PE ratios. You're buying companies with faster growth. You're looking for more disruptive companies. And with those, generally, you will be looking to accept more volatility because they're still in the early stages of growth, for example, and they're more subject to fluctuations depending on the market conditions. If there is a big announcement, a tweet, or if there is expectations of higher or lower rates, they might react differently. On the other hand, value strategies are designed for those who are looking for stable returns. There is emphasis, for example, on dividend-paying stocks. And as the word value suggests, right, you're looking for a deal, right? It's Thanksgiving sale. People I don't know if they used to line up in the past at Best Buy. I don't know if they still are, or Costco or whatever. And that's what value people look for, right? If today, this is my pajamas, right? For people like me, I have to wear this all the time. So if there's a suit and it's half price, maybe I'll buy 2 suits, right? I have another seminar somewhere else. I'm not going to keep wearing the same suit. But that's what value investors look for. You want to buy milk. Milk is half price. You have 5 kids. Maybe I'll buy 4 gallons, right? So that's the idea. But you can also consider a hybrid strategy where you take the passive funds, right? So we talked about passive, the index fund. So one of the ways to invest is just buy the whole basket of stocks. What is an index fund? It's basically a collection of stocks. So if you want who likes to shop at Costco? Just, it's Friday night, Saturday night, right? There you go. So when you go to the fruit section, right, you can either buy apples, oranges, bananas, or grapes, which is the individual fruits. But if you're tired or you're feeling a little lazy, you can buy that fruit platter. Somebody did a little bit of work, put it together, and you buy that fruit platter. So that fruit platter, you're paying a little bit more, but it's a packaged product, right? So if you buy that fruit platter, I buy that fruit platter, we're getting the same thing, right? So there is no customization. You cannot say, look, I already have apples at home. Can you switch out the apple for kiwi? No, they're not going to do that. You buy what you get, right? So that's a basket of stocks. Think of it that way. So some people can just buy that. Some people can pick and choose. I like more this versus that. And so by doing it with the hybrid approach, you're able to balance the risk and the reward. And this is one of the ways that we actually consider for some of our actively managed portfolios. And generally, as you go higher on the risk curve, you are looking to invest in more equity. And this is just an example of an equity REIT and Sukuk portfolio, just a plain vanilla. You can set it and forget it for those who are just looking for simplicity. And then if you go down the risk curve, then you're reducing your equity exposure, increasing your Sukuk exposure. And this is one way to manage risk. But there has been in the recent times challenges to the 60-40 portfolio, the traditional 60-40 portfolio. How many of you have heard of 60-40, right? Where they'll tell you, put 60% in stocks or equities, put 40% in bonds. Now, in the last 63 months, which is 5 years plus, bonds have produced negative returns. And feel free to check this across any index, right? Look at the BND, the total bond market ETF, the Vanguard one, negative 17% last 5 years. Look at the TLT, iShares 20-year bond, negative 45%. So clearly bonds are not serving in the way that they were intended, right? Most people would have tell you buy the bonds so that it protects you if there's volatility in the stock market. But what happens if the bonds are not working? That's one of the reasons people are looking at alternatives like gold or other precious metals or Bitcoin or other categories are considered because they provide other elements for diversification and helps to challenge the traditional investment model. So how do you build a resilient portfolio? I felt this was, I wasn't sure what level, but since a lot of you are seasoned, I'm sure you've been in the investment journey a little bit. So I just thought of some. I actually did a webinar just 2 weeks ago, and these were some of the slides from there. I thought it might be relevant here as well. So one of the things is don't time the market. You've heard this a lot, right? Time in the market beats timing the market. So this chart on the right, gives a simple visual that if you invested $10,000 in the S&P between January 2003 and December 2022, and you can extend that potentially even further till today. But basically, if you miss, just 7 of the 10 best days, your portfolio, if you miss the 10 best days, your portfolio would be at 29,000 versus if you invested in all those days, you would be at $64,000. But if you miss just the 10 best days, it's almost half the return. So you don't know when those 10 best days will happen. So instead of trying to time and wait for the best opportunities, sometimes it's better to at least make sure you're in the right strategy so you don't have a heart attack and ride the ups and downs. This is the other thing, taking the emotions out. Actually, on April 4th, I sent a blast to all my clients. I wrote an update. There was peak fear around tariffs. Everyone was scared tariffs are going to be the end of the world. I looked at the sentiment, I looked at some of the other indicators, and I wrote an update, and I sent it to everybody, and I said, listen, the volatility index is spiking up, fear is at extreme levels, and when historically the S&P declines by over a 2 big day decline, the forward returns over 1, 3, 5 years tends to be positive. And there was so many other indicators that were telling me similar types of information. When the volatility spikes above 50, every single instance that has happened in history, the forward 1 month, 3 months, 6 months, 1, 2 years is always 100% of the time has been positive. Maybe not over 1 month, but at least over the 1 year, 3 year. So when we see these kinds of things, forget what the cause of the volatility is. It could have been COVID, it could have been financial crisis, it could have been anything. When those triggers happen in the market, the signal is telling you it's the time to buy, or just wait until things recover. So this is one of the things we watch out for. Also, as I was mentioning earlier, if you wait to invest, after declines, you would do better than investing after the recovery, right? So when there is a decline, that's the time to buy. Be greedy when others are fearful. But even more better than that is just buying and holding. Buying and holding, since 1993, if you were buying and holding, you would have been up 1,200% for the S&P. Otherwise, you would have made 850% if you bought on the down days. So you might think it's better to buy on the down days, let me wait. No, the data is suggesting invest and just leave it alone. It's very hard to time every single bottom. But sometimes you have to follow your gut. And if you have extra capital to deploy during those opportunities, even the last 6 weeks have been a little bit volatile in the market. So there has been some opportunity from what I'm seeing also there. So there are 2 types of risks. There are some things that are known, some things that we don't have control over. Like nobody could have predicted COVID, right? But once it happens, you have to understand how to manage that in your portfolio. And so one of the ways is to pick the winners. This is one of the key points I've been telling investors is focus on the winners because the winners will take the most market share. And if you look at the share of the top 10 companies within the S&P 500, they own they make up almost 40% of the composition. In the past, it used to be 20%, 25%, but it's getting bigger and bigger. So what is this telling you? The winners and the big companies are getting bigger. Some people might argue that's a bubble, and I'll cover that in a moment. But when you diversify, you don't want to be overly diversifying. You want to select few companies, do your homework, and then you can do well. And I actually believe that in the next 5 years, this is only going to get bigger. The share of the top 10 companies will get almost 50, maybe even 60% in the next 5 years. That's my prediction. We'll see how that holds. I think there's almost half of the S&P is going to get disrupted. That's my expectation, because there's a lot of zombie companies out there. So we should not be afraid of investing in the companies that are big or that have grown in size. So what is the current climate telling us, right? If you don't anticipate what is going to be happening, you won't understand how to position, right? Investing is playing where the puck is going. How many of you have heard that? Wayne Gretzky, right? So we have an expectation for rate cuts. There were 3 expected this year. We've already got 2. December 10th, the odds have been oscillating between 90%, went down to 30%, and that's what caused the jitters. When the Fed speaks, sometimes they tend to give mixed signals and the investors get really panicky. But as of right now, the odds are close to 83%. So looks like most likely we're getting another rate cut. Why is a rate cut important? Because when rates come down, there is more borrowing, there is more affordability, because even with the home prices that we were just talking about, not only are people not able to afford those homes because of income, but because interest rates is making it even harder for them to afford. So as rates come down, it's going to make things affordable. So understanding the path of where the rates are going can help you identify which sections do well. So some industries do better when rates are going down. And so you need to understand which are those industries, how can I position myself to benefit from this trend. Tariffs, as I mentioned earlier, was a big concern, and that's what, as of July, all the analysts changed their targets. There was that V-shaped, in April. Within 90 days, S&P made a big comeback, the largest in the history, actually. And initially, everyone had a big target for the S&P. They dropped their targets. They raised their targets once again. And the point of this is not everybody is going to understand exactly where things are headed. So you have to understand what are the driving factors and what thesis are you holding on to as to how the economy is going to function, and what, if any threat does the tariffs pose. Initially, it was a big threat. It was seen as a big threat. Now it's not so much. The AI, a lot of people asking, is AI in a bubble? So generally, if you look in the past, right, we had the Oracles and the Ciscos during the dot-com bubble. They were trading at PE ratios of around 100 plus, right? 120, 130. Today, our leading companies are trading at under 30 PE. So that tells you that we're far from bubble territory. And bubbles tend to happen when technology fails to monetize. When technology company prices go up, but the revenue or the earnings does not go up, that's a problem. But that's not what we're seeing today. I mean, it doesn't mean that everybody is going to survive. Some of them, they will die. That's just how life is. So you have to be very selective, but across the board, even NVIDIA, which has been the leader in the AI world, it's not trading at anywhere near bubble territory. And I think that they still stand to position to benefit from this whole AI wave that's still happening. Also, people were concerned about shutdown, right? We just had the longest shutdown in the history of America. And historically, after the shutdown ends, within a period of 6 months or 3 months after, the S&P has on average a gain of about 9%. So the shutdown just ended. So if you follow historical pattern, there's a potential for about 9% gain. And this past week, S&P literally added almost 1.2 trillion in market cap. So boom, the market is getting back into rally mode. Again, there are always risks, but this is what the history has shown us after the end of these shutdowns. So that's the end of what I thought would be relevant for today's session. And hopefully you guys picked up something, but any questions?
So for the lady who will have a question there, we'll have a microphone on the lady's side, and we have 2 microphones on here, I think.
Yeah,
So,
you can use that.
We can use that one so the people who are watching on live stream, they can benefit also, inshallah.
I have
Yes.
a question about the index, type
Yes.
of investment.
Yes.
So let's assume that you have 2 companies,
Yeah.
and the weighting of the index is like, you take 30% of your asset from company A and 70% from company B. Are these weightings going to be fixed over time, or they change based on the,
The weightings of the funds changes based on the composition of what is in the S&P.
so you have some weight initially, and based on the, performance of the companies, it's going to change. Is that right?
Based on the performance, so we have to follow what is in the S&P Industry Exclusions Index for the SPUS, for example. And so so the only thing that we will change from our own side is if the company fails the Sharia compliance test, we have to kick it out. But everything else will follow whatever is in the index. And so if we don't have financials or weapons and all these things, that directly impacts the rest of the sectors, because then they end up having a higher percentage allocation, because we're making up, like utilities historically have too much debt. And so we don't tend to have utilities as part of the index. And so what happens to the exposure that would have gone to utilities? It gets, again, divided into the other categories that are part of the S&P. Good question. Yes. The brother in the front.
So I see the. Thank you for the presentation. This is wonderful. I see the funds that you have listed
Yes.
for the target dates. How do you invest in these funds? I searched E-Trade. It's not in there.
Right. So the target date funds actually just launched about a year ago. We are in the process. They're currently approved on the Schwab platform. We are working to get them approved on Fidelity and other platforms, Vanguard as well. And the challenge is that a lot of them wait until you have passed the 1-year mark or passed a certain AUM threshold. But in many 401k plans, actually, you can request. So if it's a company that, if you're self-employed, you can definitely include these funds in your 401. However, if you are working for your employer, you can make a request for them to either include some of these funds in the menu, right? Because if I have a job and I have to invest in my 401k or 403b or whatever the case might be, and the company is not really allowing you to invest in halal options, then you can make a request. Can you expand the menu to include some of these funds, or can you give me a self-directed option? So there is something called a brokerage or self-directed option, which allows you to then pick these funds or work with a third party like us, for example, to help manage it on your behalf. And so this is what the brokerage option allows. So you would definitely be able to do that as a way to kind of benefit from those funds. Good question. Yes, brother.
How does, do you have any data on, the performance of these index against
Yes.
S&P?
S&P,
How
yeah.
have they done? And then also, what are your fees?
Good question. So the back-tested data for these funds, especially the SPUS, which is tracking the S&P 500, halal stocks, over the last 20 years, even before the fund was launched, we went to the S&P team and they were like, why do you care about launching these? There's so many S&P products, like, don't waste our time. We said, well, the back-tested data from Morningstar showed that it was outperforming the S&P over the last 20 years, or more even. And that's really what got their interest, and that's the other reason they actually allowed us, in partnership with S&P, to launch this, because SP Sharia portfolio, but they also allowed us to use SP because S&P was involved in that. And so the performance has been, if you look at the last 5 years, SPUS versus SPY, you'll clearly see there has been outperformance across that time frame. And part of that is because there's been a little bit of higher tech exposure, because we are eliminating all these non-halal sectors, so it has a little bit heavier weighting towards some of these other categories that have done much better. Does that mean it's always going to beat the S&P? We don't know what the future is going to look like, but historically it has outperformed the S&P. In terms of our fees, now not every fund is going to beat the S&P. There's a Sukuk fund which is meant for fixed income. You have to compare fixed income to other fixed income product, right? So just like an apple, you cannot compare to an orange. So in the fixed income category, SPSK has better characteristics in terms of drawdown relative to the other bond, emerging market bonds, or even other corporate bonds. If you compare it against that, has better risk profile in drawdown periods, and the risk, the yield to maturity from the start till the end yields about 5.5%. So it has also other characteristics that stand out even in the fixed income category. So alhamdulillah, they've done well. And for the emerging markets, there's a SPWO, which is a category for developing world and emerging markets. You can compare that against EEM, which is the standard one, and even that has been doing better than that. So alhamdulillah, I think it's barakah of having halal is helping, to be honest. But you can feel free to check, because these are publicly listed funds. You can find out directly anytime against any equivalent. Second question was about the fees. So the fees for the actively managed portfolios will depend on the total assets that we're managing on your behalf. Generally, from 100,000 to $500,000 is 1.5% per year. 500K to $1 million is 1.2% per year, and over $1 million is 1% per year. So this is the standard fee structure that we utilize for the wealth management business. The funds, of course, you can check the expense ratios, but on average about 0.45 or 0.5. The performance depends again on the strategy. So for the actively managed strategies, if you're in the value category, it's going to be different. If you're in the growth category, it's different. Historically, for value strategies, for a moderate portfolio, 5 to 8% net returns. For aggressive, between 8 and 10%. For the growth, for moderate, is generally between 8 and 10%. For aggressive, 12% or more. This is what our historical returns have been. Actually, it's much higher, but I'm giving you the more realistic expectation.
And then is there another fee if you guys beat the S&P?
So you're asking me about performance-based fee. So this is, our standard fee does not depend on whether you beat the market or not. This is the fee for us to manage your wealth, right? We are helping to manage your wealth during downtimes and when things are booming. But we also have performance-based billing, which is only for accredited investors first and foremost. According to the regulation, we're not allowed to do that for any client. So if you're an accredited investor and you're willing to invest $500,000 or more, then we have the option to do the performance-based billing, which only applies if you hit certain thresholds. If we do not exceed those thresholds, you don't pay a fee.
What is the lock-in time?
We don't have a lock-in time.
So whenever I want,
Your money is with you. We are paid to manage it. Of course, investing is for the long haul, but you're not locked in unless you're in a private equity opportunity. Our regular investment wealth management has no lock-in period.
Ali, can you talk a little bit more about the don't advise
Yes.
thing? It's people,
Sure.
as I say, that's a good advantage for a lot of these people who are
Absolutely.
in the investment and the capital gain and all that stuff. And what, as an organization, what should be doing? We're registered with Fidelity. I'm just walking in the Chariot. Is that Chariot? They call it?
Fidelity Charitable?
Yeah,
Or,
yeah. I'm just working on that one.
yeah.
And we have a couple of other ones, but
Yeah.
there are more. I don't know how many out there, but
Yeah. So with donor advised funds, you have the ability to, as an individual, especially at this time of the year, right? You're in Q4, you're trying to get your tax deductions done, you're setting yourself up before your COMS. Hopefully everybody here is paying their COMS. And you can use it as a mechanism to facilitate your COMS. For a lot of our Sunni brothers, I'll tell them your zakat obligations, right? They're focused on the zakat side. And you can donate those stocks, and we can facilitate. So don't worry about the mechanism, we can help you. We identify the stocks that have done well. We can donate some of those to get you the tax deduction, because you might have bought it for $1,000, the total stocks. Today it's worth $5,000, so there is a big gain. You donate that, you avoid the $4,000 capital gains, right, on if you sold it. So you donate that, you get a $5,000 deduction, income tax deduction, because you put that money in. And it can grow for you, so you're now able to grow it. And you can open the charitable account. We use Schwab as our primary custodian, so we can help you to set it up. For donor advised funds, there's usually a back end that does the administrative side of things. So with Schwab, for example, we use Renaissance Charitable Foundation, and they help to set up the account and facilitate any grants that you want to do. So if I, as a donor, an account holder who puts my money into a donor advised fund, I can then donate to Anjumani Asghari from there. I can donate to Imam Hussein Islamic Center. I can donate to Islamic Relief or whichever other organization that you want to. And so as an individual, you get the benefit of organizing all of your charitable giving in one place. You get the tax deduction benefit, and you're able to donate not just cash but appreciated stock. As an organization, you're now tapping money that was typically not available, because now you can get money directly from people's donor advised funds. So people who have money there, they can now donate to the nonprofit organization that you are supporting, for the masjid or the organization. And you can also have an endowment, right? An endowment allows you to invest to support the organization's sustainability goals, right? You want to be sustainable at some point. I'm sure you've seen enough people standing in front of you, Muharram, make you drop every penny from your pocket. And we, as an organization, you get tired of doing that. As an individual, you want to come to listen to Imam Hussein lecture and less about donation. So how can we set up success? Have the endowment, start somewhere. Look at Harvard and Yale, 40 billion plus in their endowments. Why can't Muslim organizations think, we want $100 million, let's start somewhere? And it's doable. I've seen organizations achieve good amount of success and be on the path towards sustainability. And I think even small organizations can definitely do that. And we're here to help in any way that we can. For nonprofits, by the way, we charge half. So if you have a nonprofit and you want us to help manage the wealth for you, we charge half whatever we would charge a regular client, because we want to support.
So how do you deal with that? Because especially for us, a Shia, you have a khums. So
Yes.
So
you have to be careful with the khums, because if you have money that you have collected that is for Sadat, you can only donate to another organization. So you, as a Imam Hussein Center, you can go ahead and donate that to Al-Ain or Zahra Trust, right? These are some organizations that can accept the Sadat portion. Imam, you can use for your own, if you have the ijazah.
Yeah.
So you have to just understand, or you tell the donor, just give me what I do every year, as an example. I will donate to Zahra Trust, and I'll tell them specifically, this is the Sadat money, so they know. And then the Imam portion, I know other organizations that might be looking for something, and I'm able to facilitate directly to them and tell them, don't worry about the Sadat, this is already just Imam portion. So this is
how do we register our organization to your?
Very
You
easy.
don't have it?
We can
We can
definitely
do
get it done. I
Okay.
mean, yeah,
Well, just after this, okay?
inshallah, we can get it
Two
done.
treasures.
So I mean, you saw HIC in Orlando.
Yeah.
You know, they just started. They know me, I live there, and they finally decided to start. The hardest part is starting. And they already intending to, inshallah, do more over time. And it spreads, the word spreads, but the hardest part is starting. And the idea is we don't have to take as much risk as an individual investor. This is community money. We can be very mindful of how to manage it, but the point is that there's a lot of untapped potential in this category. And I think our job is to help unlock some of that for you guys. Inayat, you're based here?
I am now, yes.
Okay. Interesting. Muhammad Sabur, you did a good job pulling him in here. I don't think we've met, but I was,
We have not. We have
yes,
not looked into it.
inshallah. Yes, Brother Mason.
I have two questions for
Yes.
you. The first one is, you said the fee for SP is about 0.0, 0.4.
Yeah, 0.45 or 0.5. Some of them are at point, there's 4 or
So
5
all
funds.
of these indexes, they have their own fees. What's the fee for S&P?
S&P, well, for part of this fund actually is, goes towards the, you know,
Investigations.
the
and-
trust, yeah, because that fund doesn't come to us. It goes towards the trust management that is required. It goes towards the advisory, sub-advisory fee. It goes towards the distribution.
So same for S&P, I assume, right?
Yeah, so S&P might be lower, but that's because they have, you know, billions. It depends on if you're looking at VOO, for example, or other equivalent S&P 500 fund. Their funds, they can put the fee very low because they're able to rely on the volume. That's what happens. If you tell me today I'm going to invest $100 million, right? I'm sure I'll work out a fee with you. That's going to be different than any other investor because you're putting in the volume.
Yeah, hope both of you see that day. But
Right.
my second question is, now as an employee, I have 401k.
Right.
So you mentioned that I can go and talk to my 401k company that
Provider.
they add those funds into the
Menu.
account. If they do, if they don't, what are the other options that they have?
So either they can expand the existing menu.
If they don't, if they are
If
not
they don't
flexible.
expand that menu, which is less likely to happen, especially if it's a large corporation.
Like transient, I guess.
Target
that's-
date,
No,
it- Transamerica or one of these.
yeah.
Right.
Do they have it? Do you know?
It depends on the provider. It depends on the company, less so on the third-party administrator. The third-party administrator or the platform is just the platform. It's just to facilitate the investment. They don't have anything to do with the plan features. The plan features is decided by the employer. So you want to ask the employer, and you can get a group, you know, employee resource group or something, put yourselves together, talk to Mohammed Sabur as the attorney. He'll guide you on how to rally the troops together, get them in a meaningful way. It doesn't have to be Muslims only, right? People who are of other faiths might care about flexibility within their investment choices. And I've had some success with that. I can give you some template email, use that, get me as a resource. I'll speak to the HR if I have to. No problem. But the point is that they will, you know, either expand the menu or they will give you the self-directed option, which allows you to not be restricted to that menu entirely, and you can pick your own.
But I don't have time to manage those. So usually
Exactly.
they
You
come
don't
with
have the
that-
time. We have the time. This is our bread and butter. You can hire us. There is a limited power of attorney. You're basically hiring us to manage on your behalf. So as long as they allow the flexibility, then we can manage it on your behalf. Based on your age, your risk profile, and all those factors, we can buy and invest on your behalf.
And that is the one that has 1%.
Exactly.
2%
Exactly. And so you still get the company match. If you choose to benefit from this brokerage option, if it exists, you still get the match. You still get the tax deferment benefit, $23,500 or whatever the amount is, the limit from the IRS. You can still put that in. But now we can enable the investments to be aligned with your values.
So does it mean that I have to go through the company that I have right now and then give you access to that to manage it for me?
No, you have to first
Or do I have
navigate
to
with them.
roll over it to your company somehow?
You can roll over if it's an old retirement account. So let's say you worked 5 years somewhere, it's the 401k sitting there. Well, you can roll over that old one to an IRA and we can manage it on Schwab for you. But for existing 401k, where you're still employed by the company, you want to first find out, is there an ability to add to the menu? If not, can you at least allow a brokerage option, a self-directed option?
I see. So then instead of going to my company, it comes to yours.
Exactly.
Um,
And
Okay.
the brokerage account can be established on Schwab. It can be established on Vanguard, Allied Financial Solutions, whichever the brokerage account is. They would then add us as a limited power of trading authorization to then go in on your behalf and buy and sell, and
So
that's
if
it.
I do that, then I can roll over everything that I have, even with the company that my company supports right now.
Not
to-
all. Sometimes they might tell you 95% can go, 5% you still have to leave it. Well, at least better than zero, right?
Okay, I have a mixed,
Mhm.
like, ROA, all of these
Right,
things that I don't know what they are.
right.
Do you support all of those? Like some of them are pre-tax, some of them is after tax.
Yeah, as long as it's in a brokerage account, we can help. And if they don't allow even the brokerage, I'm happy to look at your existing choices and give you my 2 cents. Be like, based on these choices, try and go with this.
Okay, and then the last question.
Yes,
I asked more than two, sorry.
no problem.
Like, some of these accounts we can get borrow against it. If
For
we go-
401k, yes, you still can borrow against your brokerage account because it's still part of your 401k.
I see, okay, thank you.
They might ask you to move it, some of it back to the core, but if it's in the 401k, you can borrow as long as the plan allows that. Let me see. There has been any questions here? Any questions from the ladies' side? I have to be fair. I have 5 daughters, so
They
I have to
understood
ask the
everything,
ladies.
so-
Can I? I plead the fifth. Yes, Brother Hansel.
So the first question is that, based on what you have presented,
Yes.
I thought, I understood that most of your focus is based on some macro, or fundamental parameters. Do you have any kind of algorithmic trading strategies like, Rentec or other hedge funds that they do some sort of high frequency trading or something like that? Or you
Right.
just have some, evaluation based on these parameters that you
Right.
mentioned? And the other question is that, your focus is just on stock market in the US, or do you consider other alternative in other countries or cryptocurrencies? So that's
So good question. Do we use other prompters like high frequency trading? Number one, we are long-term investors, so we don't believe in. Not that we don't believe. I'm sure there is others who can do it. That's not the formula, or that's not the approach that we use to invest. We believe in investing as though you're buying a company, and so you have to understand the fundamentals behind the company and focus on more on long-term kind of solution. In terms of international versus US, we have international exposure. Like one of the funds is a SPWO. It's a S&P Global Emerging Markets exposure. So you get that. Even the technology fund, SPTE, is a global technology fund. So we get exposure to those through the fund. But also within the actively managed portfolios, we can be selective in picking companies that we can own that are listed in other, like ADRs. But in terms of, what's the last question?
I was mentioning the cryptocurrencies
Yes,
too.
crypto. So I mentioned we have private funds. One of the private funds that we have is investing in digital assets.
So, I want to make sure that I understood in the right way. So you don't treat all of the investors uniformly. Based on my
Correct.
preferences, my situation, you have some kind of personalized recommendation,
Custom.
finance. Is
Yeah.
that right?
That is correct. We have customized, we have about 21 different models for the regular wealth
Okay.
management. And then there's alternative investments like the digital asset fund. There is a real estate private fund that is investing in single family, some commercial. and we have a new one that is focused on private equity offerings as well. So they're all, depending on the client situation, customizable. And I'm actually one of the portfolio managers for the growth strategies in particular, as well as the crypto fund.
So I got a question here online. Somebody sent it in. I don't know how I got into it, but anyhow. He's saying I have an existing financial advisor, which I'm paying for it.
Yes.
About same what you mentioned.
Uh-huh.
What would be a good time to move it, and is it easy to move from one financial advisor to your company?
Good question. So if you're working with a current advisor, number one, it's mainly we deal with the custodian. So you have two ways of doing this. You can, if you have your account held at Schwab, as an example, you can send us your statement and complete whatever the onboarding steps are for joining us as a client. We would then initiate the transfer from the custodian that is currently holding your assets to the platform that we are using, which is Charles Schwab. So maybe you're at Fidelity, we can move the assets to Schwab. Now you have a choice on how you handle your relationship with your advisor. You can either tell them that, hey, Mohammed, I found another company that I want to work with. I'm initiating a transfer, just giving you a heads up. You can do it that way. Or if you really don't want to be involved in that conversation, you can be under the radar. We will handle it. As long as we have the statement, we will initiate the transfer on your behalf to the platform that we're using, and the transition will happen that way. So this is the two ways to do it.
One of the questions inside is, what will be a good time to do
What
it?
is a good time? A good time is based on your personal preference, to be honest, because it depends on when you're ready. Our doors, it's like, when is a good time to eat a shawarma? If you ask the restaurant, any day is a good day. Come on Monday. You like Monday? No problem. We're open on Monday. So, it just depends on our doors are open 24/7. You email me on a Saturday, and hopefully I'll respond on a Saturday. Or Sunday, I'll show up here.
I have
Yes,
two
Mohammed.
questions. Thank you very much for the presentation. I appreciate especially enlightening advice given the current market. Two questions. One is, can you explain the difference between the investor shares and institutional shares?
Uh-huh.
And then the second question is, kind of piggybacking on Brother Mason's question.
Yeah.
I joined my current employer about a year ago. It's only 120 people in the organization, and they actually offer Amana funds as a halal investing options. I mean, even through our current 401k provider. So to Brother Alireza's point, they would probably be very willing to expand your offerings if you explain that there are religious reasons for wanting to seek religious offerings. I didn't even do that. That was done before I even joined my organization. So to that point, can you help me understand, where does Amana, which is a name
Yes.
I've heard of for a long time, where do they fit in? And what's
Right.
how do I think of them versus
Yes,
kind of the work
absolutely.
that you do?
Good question. So number one, institutional versus retail. Institutional shares are generally designed with a lower fee, but they tend to require a larger volume. So, if you want cheaper, buy wholesale versus retail. Think of it that way. If you're buying in wholesale, bulk, you get a little bit better pricing versus retail. And that's the main difference. You're still getting the same product. Nothing is different about it. You're just getting it at a discounted price.
Are there certain thresholds for your?
So right now we're actually being very, I think they might not even be charging the retail fee for the institutional. So, they might not be charging the institutional fee for the retail. You're getting a cheaper one no matter what. At this stage, right, they're trying to do that, but I think it's gonna be around 50 or 100,000 or something like that, maybe. You can check the prospectus. Don't quote me on that. Hopefully it's not recorded. Don't want to get in trouble with compliance there. Minnesota discounts, not for the funds, for something else maybe. If you get a large group of investors, maybe I'll treat you to some Afghani or something, whatever. Free pizza day, I used to get those at Wells Fargo. You do the best job, free pizza day. I'm like, what the heck is going on here? Or wear jeans. You get to wear jeans. So, second question, Amana Funds versus SP. Number one, Amana Funds is a non-Muslim company, non-Muslim owned and operated. It's under the umbrella of Saturna Capital, which is a non-Muslim company. So just something to be aware of. We're a fully owned and operated Muslim company. Number two, Amana Fund's halal criteria is slightly different. Doesn't mean it's right or wrong. This is just their interpretation is a little bit more on the liberal side with some of the things. AOFI is seen as the strictest and the most widely accepted in the industry. Do with that whatever you wish, because scholars can differ, and that's fine. Number three, SP funds relative to Amana funds last 5 years, the growth funds and the technology funds are outperforming Amana funds, and they are lower expense ratio. This is objective facts. You can cross-reference any of these things. Number four, I love the Amana folks. I know all of the folks. I work with them. We use the Amana funds in some of our strategies because of the restrictions that we run into sometimes with certain platforms and certain account types. We use them because clearly they're good products. Nothing wrong with using them. But we have obviously tried to expand the menu to include other options that are not. So Amana Funds doesn't do target date funds, for example. We have launched the target date funds because we saw a void in that space. Amana does not have an S&P product. We do have S&P products. So this is some of the differences. But they have done a phenomenal job in trying to push for 401k plans to be more open to including this. And that's why you've seen that in that space. And we are trying to go down the similar path, but trying to push for the target date funds. Because I think for most investors who don't know how to invest, who don't have the know-how or interest, they can go ahead and buy the target date fund. If you're retiring in 2050, you buy the target date 2050, the fund automatically rebalances for you, and you just set it and forget it type thing. And it gets more and less aggressive as you approach the retirement age. So these are some of the differences. I'm sure there are others I can highlight, but it kind of gives you an idea of.
Can you explain about that sukuk? What it is, how does it work?
Right. So sukuk is basically a product that offers dividend instead of interest. Because when you borrow money, let's say they want to expand 610 highway and build 4 lanes or 10 lanes like Texas, right? This 4 lanes is not enough. So they need to raise money to build more of that. How are they going to get the money? They issue bonds. You give them money. In exchange for your money, they give you interest. So instead of doing it that way, sukuk is asset-backed. So you're getting, there is no debt financing involved. There's no any kind of borrowing from that lens. It's let's say the asset is already bought. You're just paying like an airplane. It's already bought. You're providing the money, and whatever the airplane rent is or income is generating like a toll, you get the income from that. So that's the model is slightly different from that lens. Also, sukuk cannot be used to finance non-halal buildings. Like you cannot use the sukuk to build a casino, for example. Debt, bonds can be used to raise money to buy a casino. And you might be a bondholder with that type of stuff. These are some of the common
Bonds is more for
government and or corporations. They use bonds to raise capital for different projects. It could be used for government project, it could be used for private other business project that the corporation is looking to do. These are some basic, but there is other nuances around that as well.
You also mentioned about credit cards.
That is under a finance arm. So we're launching a new initiative. No problem. If anyone wants information request form to follow up, let us know. Thank you, guys. Any other questions? Sorry. Yeah, as the finance is under a separate entity that is going to be offering no interest credit cards as well as auto loans and other initiatives. So that's coming up in the pipeline. Yes. Well, you can sign up for the newsletter and sign up for that because it's still in the early stages. They are working on the mechanics right now. It is disrupting. We're trying to disrupt that industry. The traditional credit card model gives you. They're cooking all of that right now. I'm just highlighting that it's in the pipeline. No, there is no. It's gonna be zero interest, as the name suggests. SP Zero Finance. That's the company name. The entity is called SP Zero Finance. You can check it out online. Any other questions?
Okay, one question.
Yes.
Like for example, I donate some money every month to the masjid.
Okay.
It's not much. Is it better to go through the donor fund for me and masjid?
Right.
Because at the end of the day, I get my tax deduction.
Right. Whether you give it through the
Yeah.
DAF or the other.
Yeah. So
The donor advised fund is more beneficial if you're planning to deposit a larger amount than what you're intending to donate. So if you're intending to donate $10,000 in the year and you have larger income that you're wishing to get a deduction for that, and you want to put, let's say, 50,000 and get a deduction for 50,000, but you're willing to donate 10,000, which is what you are planning anyways, then there is a benefit because 10,000 is gone, 40,000 is left. That 40,000 can be invested, can grow to 50. Now you have more that you gained from the investing that is tax-free and that you can donate.
So basically, that is out of your assets.
Correct. It's
It's
no longer
belong to
your
the
asset. You have
donations.
the control in terms of where you wish to donate, but it is no longer your personal asset
That's
once
nice.
you donate it.
So you're stuck with us. You can't come out of that. Okay, look like we don't have any
Yes,
more
I
questions.
know
Do we have
that-
any question?
I also want to respect the time. I don't know what time we have here.
Normally
the
the
community-
Iranian are pretty good.
Yeah. Alhamdulillah.
01, so it's good. Thank you very much, Ali, for doing all this. We do have some question, I think, on the side. So they'll do it on one-on-one.
Yeah,
Okay.
absolutely. And my
Thank-
contact is available. I'm happy to arrange one-on-one.
Sure,
with
and
anyone.
I think you're here till Monday, no?
I'm flying tomorrow.
Oh, tomorrow. Okay. So he's here till tomorrow. Any question, of course, you can talk with him one-on-one. Thank you
Yes.
again for coming back, and
Absolutely.
looking forward to see you again. Thank you.
Absolutely.
Bye-bye.
Salawat.